Subscribe to my channel Report Stock.
Welcome, curious minds, to another deep dive. Today, we're plunging into a story from, well, the bustling world of hospitality tech, specifically a company that's been trying to rewrite the rule book for modern travel. We've got a stack of their latest financial results, a truly massive strategic partnership, and some, let's say, urgent news from the NASDAQ. We're talking about Sonder Holdings, Inc. You might recognize the name. They're a global brand known for those, design-forward apartments and boutique hotels. They've popped up in prime locations across 40 cities, 9 countries, 3 continents since 2014, promising that blend of inspiring design and sort of tech-enabled service. Our mission today is to sift through their recently announced Q1 2025 financials, unpack this really game-changing collaboration with Marriott, and address some pressing regulatory notices. It's a classic innovator's dilemma story, isn't it? How do you balance that ambitious growth, disrupting the market, with the nitty-gritty of financial health and, well, compliance? We'll explore what all these developments mean for Sonder's strategy, their future, and what truly stands out in this rapidly evolving market.
It really is a rich and complex narrative. You've got, on one side, some genuinely strong operational improvements and this pivotal alliance that could, dramatically reshape their trajectory. But then on the other side, there are these clear financial headwinds and, frankly, critical compliance challenges that demand serious attention. What's fascinating, I think, is how these very different threads intertwine. It paints a picture of a company very much at a crossroads, sort of trying to balance that rapid innovation with foundational stability.
Okay, let's unpack this for you so you can walk away not just informed, but with a real sense of the high-stakes tightrope Sonder is currently watching. So where is Sonder financially on this journey to redefine travel? Let's crack open their Q1 2025 numbers. They ended March 31st, announced August 25th. Spoiler alert, it's kind of a story of calculated sacrifice and maybe some surprising strengths. On the positive side, some key operational performance indicators are looking, well, surprisingly robust. Real momentum within their existing properties. For instance, their RevPA, or that's revenue per available room, hit $139. That's a solid 13% increase year over year. And their occupancy rate climbed to a pretty robust 83%. That's up 7 percentage points from the previous year.
Yeah, and the real takeaway there is fascinating. Despite a significant strategic shift we'll get into, Sonder is actually extracting more revenue from each available unit and filling a higher percentage of their rooms. This isn't just healthy demand. It feels like a validation of their refocused strategy. It suggests that the quality, the curated experience they offer, even if it's maybe on a slightly smaller scale now, is outperforming just broad expansion in this market. It's like a pivot, from growth at all costs to maybe profitable growth, which is just such a critical shift for a company like Sonder.
Right, profitable growth. But then when we pull back to the overall revenue picture, it shows a decrease. Total revenue was $118.9 million. That's down 11% year over year. And perhaps most strikingly, bookable nights, that's the total number of nights available across all their live units, decreased by 21% year over year, hit just 858,000. That's a pretty dramatic drop in capacity, isn't it?
It is dramatic, but it's not random. The source explicitly attributes this to their portfolio optimization program. So this signals a very strategic, a very deliberate decision to actively reduce their overall number of available units. They're likely shedding underperforming properties or maybe consolidating the portfolio to really focus on efficiency and profitability. Even if it hits their top-line revenue in the short term, they're effectively saying, look, we'd rather have fewer, more profitable, better-performing units than just expanding for scale. It's a significant move.
Quality over quantity, perhaps. Okay, diving deeper into their financial health. Sonder reported a net loss of $56.5 million. That's actually a 12% increase year over year. But then we see these adjusted figures, like adjusted EBITDA at negative $56.7 million, showing just a marginal 1% decrease year over year. And adjusted EBITDA at $21.1 million, which is a 20% decrease. Now, for our listeners who aren't maybe knee-deep in financial statements, why? Why does Sonder, or any company really, emphasize these adjusted numbers? What are they actually trying to tell us about the core business here?
That's a great question, because adjusted often does mean we want you to focus on this part of the picture, right? Companies use these non-GAAP measures, not according to generally accepted accounting principles, to kind of strip out items that might obscure their day-to-day operational health. Think non-cash expenses like depreciation or maybe one-off restructuring costs, things like that. For Sonder, their adjusted EBITDA is like their internal compass for core performance. And adjusted EBITDA goes a step further. It specifically removes the heavy impact of their operating lease obligations. which are, significant for a company like Sonder that primarily leases its properties. It's about seeing if the fundamental hospitality business, separate from those big structural costs, is moving in the right direction. So while they're still showing losses, that marginal decrease in adjusted EBITDA could hint at some stabilization in their underlying operational efficiency. Maybe?
Okay, stabilization potentially. So profitability and revenue are challenging, but let's shift to something every growing company lives and dies by: cash. And here, wow, we see a dramatic turnaround that really catches the eye. Their cash used in operating activities was only $4.4 million. That's an impressive 89% improvement year over year. 89%. And maybe even more compelling, adjusted free cash flow was negative $6.9 million. But that's a staggering 76% increase year over year, which means the negative number got much smaller. How big of a deal is that improvement considering the other challenges?
It's absolutely crucial. This improvement in cash flow is a powerful positive signal amidst those other challenges you mentioned. Adjusted free cash flow, they describe it as their primary liquidity measure. It's central to their whole cash flow positive plan. So this substantial improvement, this 76% jump, suggests they're really managing their expenses and operations much more effectively. They're getting much closer to their goal of achieving sustainable positive cash flow. For any growing company chasing financial sustainability, this is a key indicator. It shows a real concentrated effort in managing their cash burn. And you can see that reflected in their total cash, cash equivalents, and restricted cash. It stood at $66.5 million as of March 31st. This laser focus on liquidity, it feels like a strategic imperative for their long-term health.
Right, imperative.
So while Sonder is meticulously streamlining its operations, managing its cash, they've also made this huge play on the growth front,
Right.
one that could fundamentally reshape their future.
Yeah.
We're talking about a game-changing alliance with none other than Marriott International. This agreement, it was initially inked back in August 2024, and the full integration completed in the second quarter of 2025. So this isn't some far-off future plan. It's very recent, highly impactful, and already in full swing.
Yeah, and here's where it truly gets interesting. You can almost see the strategic vision coming to life, right? As of June 2025, all Sonder properties are now available for booking on Marriott's vast digital channels and platform. Imagine that. Instant access to a massive global audience via Marriott.com and the Marriott Bonvoy mobile app. They even have a new dedicated collection, Sonder by Marriott Bonvoy, that really solidifies their presence within the whole Marriott ecosystem. And it doesn't stop there, does it? Sonder's properties also participate in the Marriott Bonvoy travel platform. That's Marriott's hugely popular loyalty program, which means guests can earn and redeem points for stays at Sonder, integrating them fully into one of the largest, most valuable loyalty programs in the entire travel industry. So what's the real strategic advantage for Sonder here? Is it just eyeballs?
It's way more than just eyeballs, though that's a big part of it. The advantage is immense. This partnership gives Sonder, unprecedented exposure to Marriott's global customer base. And it lets them leverage a powerful booking and loyalty ecosystem, something that would be incredibly expensive and, frankly, time-consuming to build themselves. It's a huge step for brand visibility, and it could be a significant accelerator for future occupancy and revenue growth, especially as that portfolio optimization continues. It's quite an astute strategy, I think, for an innovative brand like Sonder to lean into the established strength of a global giant like Marriott, while remarkably still maintaining their distinct identity and that unique guest experience. It really shows a thoughtful approach to scaling.
A thoughtful approach to scaling, yes. Okay, now let's pivot. We need to talk about some of the headwinds, the challenges facing Sonder on the regulatory front, specifically regarding their listing on the NASDAQ stock market. These are the kinds of issues that can certainly give investors pause and highlight areas where a company maybe needs to strengthen its internal processes. So the company received a deficiency notification letter from NASDAQ. This was on August 20, 2025. This notice basically said Sonder is not in compliance with NASDAQ Listing Rule 5250C1. That rule requires timely filing of all periodic reports with the SEC. Specifically, this notice was for their failure to timely file their quarterly report on Form 10-Q for the quarter ended June 30, 2025. That's their Q2 2025 Form 10-Q.
Right, and this isn't actually the first time Sonder has faced such a notice, which I think makes the situation even more significant. They previously received one back on April 24th, 2025. That was for delinquency in filing their annual report. The Form 10-K for the year ended December 31st, 2024. Now, they did manage to file that 2024 10-K on July 23, 2025. So they addressed the first issue eventually, but clearly a new one has popped up pretty quickly.
So there's a pattern developing here. For that earlier 10K issue, Saunders submitted a plan of compliance to NASDAQ back on June 23, 2025. And they have until October 13th, 2025 to regain full compliance. I mean, that deadline is fast approaching.
It is. And for this more recent Q2 2025 10Q delay, they're required to submit an update to that compliance plan to NASDAQ. And that deadline is even sooner, no later than September 4, 2025. The company stated the delay was, and I'm quoting here, to allow sufficient time to complete its customary accounting and internal control processes and procedures. End quote. That phrasing is quite telling, isn't it? It suggests they are actively working on strengthening their internal financial reporting mechanisms, which is good, but it's clearly impacting their ability to meet those critical deadlines right now.
So the critical question for investors, for anyone watching Sonder, isn't just if they'll file, but what these repeated delays signal about their underlying operational stability, right? I mean, while they say they're working diligently to complete and file the Q2 2025 Form 10Q as soon as practicable, these repeated delays, they can be a significant red flag for the market. They highlight potential operational or internal control issues that, well, they need to be addressed promptly and effectively, because consistent, timely financial reporting is just a cornerstone of public company trust.
Exactly. It's foundational.
Okay. We covered a lot of ground today. From those improving operational metrics, the major strategic alliance with Marriott, to, well, the persistent financial losses and these critical regulatory challenges, bringing all these threads together, where does this leave Sonder? What's the path forward heading into the future?
Well, Sonder appears to be in a really crucial, maybe defining transitional phase. That's how I see it. On one hand, you got the increase in RevPR and occupancy alongside those significant improvements in cash flow from operations and adjusted free cash flow. That strongly suggests their strategy, optimizing the portfolio, improving unit level performance, is starting to yield tangible results. And the Marriott partnership is undeniably a powerful positive. It offers a major distribution and loyalty boost that could genuinely accelerate their path to profitability and just broaden their market appeal dramatically. These are all really powerful indicators of an effective business strategy taking hold.
Okay, that certainly sounds promising. It paints a picture of a company making smart strategic plays. But then, on the other hand, we have these nagging losses and these glaring regulatory issues. How do you square those two things? Is Saunders' strategy, the optimization, the Marriott deal, is that actually contributing to the compliance problem somehow? Or are they just separate beasts they're fighting?
That's precisely the tension, isn't it?
Right.
And it's not uncommon, actually, for high-growth, innovative companies to kind of outpace their internal infrastructure for a while. Saunders' stated reason for the Q2 delay, those customary accounting and internal control processes, it suggests that their aggressive strategic shifts, while very forward-looking, might have just momentarily stretched their back-office capacity a bit thin. It's that classic innovator's dilemma, right? You're trying to build the plane while you're flying it. But you absolutely cannot forget the maintenance checks and the air traffic control regulations. You just can't. So the next few months leading up to those October 13th and September 4th deadlines, they are going to be absolutely critical in demonstrating their ability to regain compliance and stabilize their operational infrastructure. And you could bet the market will be watching very, very closely.
It's certainly a story of contrasts, then. We've seen Sonder making truly strategic moves to improve its core business, expand its reach through this powerful partnership, while simultaneously grappling with the very real challenges of profitability and regulatory compliance. It's definitely a complex, evolving story, and one with pretty significant implications.
Yeah, I mean, Saunders' journey really highlights a universal truth of these kinds of disruptors, doesn't it? Innovation can win hearts and minds, win market share, but it's the rigorous execution and the compliance, the boring stuff sometimes, that keeps the lights on and builds that long-term investor trust. They're clearly betting that shedding properties for profit and leveraging Marriott's massive reach will solve their growth issues. But those internal control gaps, the reporting delays, they can still trip them up. It really is a high-stakes tightrope walk. And the next few months will show, I think, if their foundation is finally strong enough to support their ambition.
So as you reflect on Sutter's journey, maybe consider this. In a rapidly evolving market like modern hospitality, where innovation is absolutely key, but trust and operational integrity are paramount, where do you draw the line? Where do you draw the line between aggressive growth and that meticulous operational excellence? Is it always a trade-off, or can a company truly master both simultaneously? Something to think about. That's all for this deep dive. We hope you feel better informed and ready to keep exploring. Until next time.
Subscribe to my channel Report Stock.